Great. So Juan, Kari, Brandon, welcome. Let me, in that spirit, quickly introduce myself. So I'm Gaurav Patankar, oversee alternative manager research here at Bloomberg. Have done a variety of things for the last 23 years. I basically was the CIO of a family office, just under $2 billion. Prior to this job here at Bloomberg, was at the Lockheed Martin pension plan, where I oversaw hedge fund manager research and allocation. Prior to that, worked at Millennium Partners, the hedge fund, and before that, started my career at Solomon Brothers in equity research, covering the U.S. banking sector, which sometimes can be exciting. But that's me, and I'm originally from India, and delighted to moderate this panel. So I think, look, there are many interesting things happening within the alt space, and let's get straight to kind of the left ventricle, as they say. Let's get to the real elephant in the room. It's essentially the duration of the alts portfolio. We have all been talking about it. We have all been talked to. A lot of questions have been asked. Is it the time of should I stay, or is it the time of should I go? When it comes to, okay, we have this alts exposure, private market exposure. We have had a bit of a mini rally in tech, or mini rally in some of these assets. Private markets are not fully taken. So I want to set the stage and ask the panel, at what stage or what innings, and I'm going to try my best not to use American sports analogies, but what innings are we in when it comes to the marks on private assets? I mean, is it time to secondary out some of the exposure, or is it time to actually be opportunistic and step in and hold our nose and say, okay, for the long term, we're going to be fine. Let's step in and kind of partake in this opportunity. Maybe Kari, will start with you in this case, and maybe go around the table.
Okay, thank you. A lot of questions in one question. Let's say that maybe if I start with duration, and I think that the secondary market question is totally another question of this environment. But talking about duration, first of all, we have to think about what kind of duration we need, because I see that we are looking fixed income portfolio. There are areas or markets where the change in interest rates has already happened during last year, and also some areas where the interest rates and also central bank rates are already quite high. And if we are going to the emerging market debt side, there are two-digit yields what are offered by the many countries, and also central bank rates tend to be quite high, and it's even we can even expect that the next moves from many EM central banks will be to decline central bank rates, which means that there are clearly places where you should be long in duration. In developed markets, let's say it highly depends in different markets. What are your inflation expectations and expectations? What's going to central banks do? But then when going to the equity side, and we can also define that growth stocks are long duration bets compared to value stocks, which tend to be short duration bets. There we have seen a huge rally in US tech markets, and we can say that it has been a good time to be in duration. Is it, or has it been gone too far? Maybe. And that's why I would be quite careful with that kind of duration. And then when going to the private markets, I think that we haven't seen any revaluation in private markets in many places, in private equities, private real estate. These are places where I'd like to avoid adding duration, maybe vice versa. It's time to be a little bit cautious with the duration or asset allocation in those markets.
That's great perspective. Maybe, Brendan, from a family office standpoint, it would be great to hear how you guys think about some of these challenges.
Well, I guess in terms of the long duration, venture capital would be the easy way to play it, but that sector's sold off quite substantially, and there could be more pain to come. So I don't want to be too early in allocating to that. I feel like sitting on your hands and waiting for things to get a bit more clarity would be, a little bit better. Park your assets in more liquid securities, even the risk-free rate would do, and then look for attractive opportunities. I guess in the family office side, often we could go direct with other family offices, so you get a little bit more, I don't know, exposure in the equity of the business. So it's better, I think, as of right now, to just wait, see if these valuations come down, and then deploy more aggressively.
Juan, how are you seeing it? How are private bank investors or clients thinking about it?
Well, I think that when it comes to liquid assets, I mean, in terms of duration, well, I would say that maybe we would be thinking about the venture capital, about the technology investments, and obviously, well, we can think that duration here can be higher than in other segments of the illiquid assets. Obviously, it has been 2022 was a very complicated year after wonderful years previously. But well, I think that we think that there's a new era around like the maybe the free money time is over, and right now we have to look for different ideas. But anyway, well, we think that in the liquid assets, it seems that the GPs or the managers, well, there's a huge dispersion between the winners, the losers. So obviously, it's very complicated to identify them, and especially sometimes it's very complicated that they can give you access there. We have been talking to some of them, and they say that obviously last year was terrible, but they were able to find opportunities that some of them said to us that in some years we will think as 2022, 2023 vintage as very good in terms of performance, because the opportunities that they could find during that last year were great in comparison with the previous years, where there were so many leverage and free money trying to look for opportunities. So there were higher valuations, and it would be a bit expensive. But in terms of asset allocation, obviously it's very complicated. I mean, you never know when is the bottom of the market in order to get there, and it's not an easy market. But just to simplify, in terms of duration, maybe if we go to the venture capital, obviously, well, we have to look for the leverage. We have to look for the multiples that they have been paying, but maybe there were opportunities, right?
Yeah, that's a prescient point to make. Because one of the things when I work with LPs across the world, I think there's an increased scrutiny of some of the venture portfolios or the cutting edge of buyouts, where people really want to dissect the portfolios. And at the end of the day, a zombie company is a zombie company, whatever, you know, up round, down round, you know, whichever way you value it. So I think really understanding if there are any zombies in the portfolio, or if not, why would they not be? I think that's kind of taking a lot of the LP time. Now, that brings me to another question, which is kind of this whole second bring out exposure. A lot of people are, I mean, both as an opportunity and a challenge. A lot of the people who are quite loaded up on private exposures are thinking of secondary as a way, and this mini boom or whatever, the mini stability that we have in asset prices, at least in the public markets, to kind of just ease off some of the exposure. And then there are others who are saying, you know what, we want to step in. And I think Brendan made a great point that maybe, you know, it's difficult to be too early. And I hear that a lot from various family offices, and I would love to be corrected if I'm wrong, but I get an impression that if anyone steps in early, those would likely be single family offices, you know, various places, because they could really make those decisions quickly. Just curious to know, how are you guys thinking of various secondary funds or opportunities being presented to you? I mean, are valuations or the marks on those funds, or just the ROIC when you guys analyze those funds, are those becoming more attractive by the day, or do you think there is enough wood to be chopped from here for the secondary opportunities to become attractive to you? Anyone can jump.
If I start, yeah. Let's say I think the whole private equity markets, including venture capital, buyouts, or anything, I think that the major question at the moment is that because we know that interest rates are positive, they are quite high compared to the last decade. That means that we cannot buy just promises without cash flows in this kind of environment, because companies, they won't survive for a long time without cash flows. That means that we have to be quite selective when operating with the private assets, and also when thinking about secondaries, we have to be selective if we really believe that the valuations are right also in the secondary markets. And then if there are, I'm quite sure that there are a lot of opportunities as well in secondary markets, quite good stuff with good cash flows, which are priced down. But I think the major point there is that how you can justify the pricing of valuation also in secondary markets, because what we see is that buyout valuations are still quite high. We haven't seen any correction. We know that secondary market is trading maybe from 75 to 85% of the NAVs, but I don't have any idea is that cheap or not, and that's the problem there. And I'm sure that there are opportunities, but you need to go to the details to understand what is the real value behind that.
That's a great point.
Yeah, I would say that I agree in general terms with Kari. Obviously, it's very complicated to, for example, I mean, it's very complicated to know exactly what you are buying. I mean, obviously, you have to make your due diligence, and you have to be very active, and you have to have all the potential information that you can have. It's not always easy because sometimes you don't know. Well, many times you don't know exactly what will be included in the portfolio. In general terms, I would say that we like secondaries in terms of as an approach, as a first approach for illiquid assets, because sometimes it can help you in order to smooth the returns. It can make you, I don't know, a softer J curve, because well, they can invest in different terms, in different stages, different sectors or geographies. So it can be like a good approach in order to invest. Some of the secondaries managers that we have been talking with, well, they say that last year, well, there were some forced sellers. Well, they could have some opportunities, obviously. And here, I would say that maybe valuations are not cheap at all, but maybe a little bit cheaper than they were in the 2020, 2021 with the cheap money party, or party, if you allow me. Obviously, a bit cheaper, but well, giving some access to the market. So it's always complicated in terms of making the due diligence, trying to get to know the manager as much as you can, and to identify and to have the confidence with them in order to get as much information as you can have.
I think you make a very interesting point. I think just between the two of you, I think what we really draw the two big commonalities was around the lines of rates being higher. So there's price for money. There's no free money. So some of the models, not everyone might be a zombie, but there are going to be a few of them, and then some others are not going to be at the level of ROIC that may have initially been underwritten. And is there enough this time? But I think the other point one that you made around complications, like really underwriting complications, that really segues very well. But the other topic I want to tease out, very related, in a portfolio construction concept, right? I mean, constructs rather. You think of private assets, and everything has to stand on its own 2 feet. And you know, when I work with a variety of different asset owners across the world, I mean, the question is, okay, why should this asset, why should this exist in the portfolio? When everything has to justify its existence. Private assets are going to have to, you know, give some good answers as to what should the allocation to private asset be. But more importantly, and it's going to be different for different types of asset owners and, you know, liabilities and all kinds of calculations. But what should the expected rate of return on private asset be? Should it just be public equities plus 300? Does that bar go higher after what has happened over the last couple of years? And again, the point that you make on complications, because there's a lot of complicated underwriting one needs to do, and should that be justified in even higher expectations? So now you have A, higher rates, and then B, you want higher expectations, and can this asset class bear? So just to simplify the question, are we going to be expecting more from private assets, you know, in asset allocation context? Maybe we'll go around the horn and see how different investors are thinking about it.
I guess I'll go first. I would, yeah, definitely expect more. This sort of risk-free push the bar up for everything. And I guess in terms of alternative asset class spectrum. Say you think hedge funds could generate more liquid hedge funds could generate, +3, and then adding on the liquidity premium and then the complexity premium of private equity. You could be looking, well, maybe, +6 or something like that, just to justify the allocation.
That's a high bar.
Well, in my opinion, for example, I would say that obviously when you are investing in illiquid assets, you are looking for the illiquidity premium. So obviously there's a high bar, I would say, as you mentioned. Well, maybe expectations can be high if we take into account the past performance of some of the managers. But in some segments, well, we could have surprises, or maybe I wouldn't say surprises, but we could have different expectations. I mean, with higher rates, maybe cost of financing could be higher, and I don't know if all the companies will be able to deliver the same multiples that they have been delivering in the past years. So maybe taking into account if we make the discounts, maybe it could be lower returns in some segments. Maybe I would say, for example, in more mature segments or in venture capital. But on the other hand, there could be different expectations. For example, for infrastructures, usually it was a good hedge against inflation, so it could be helped at least in nominal terms. Obviously, we'll see in real terms. But there can be different winners and losers between the different asset classes. For example, infrastructures could be favored by this environment, but I know some of them we should readjust the expectations in terms of returns.
To continue, on my opinion, we are expecting too much from illiquidity premium. My expectation is that it might be negative, the illiquidity premium for the next 3 to 5 years. When taking into account that what kind of decade we have had, if we take 10 years from 2012 to 2021, S&P 500 has returned over 16% per annum every year during that 10-year period. Private equity index, buyout index has performed 17% per annum for 10-year period. At the same time, Nasdaq over 23% per annum for 10 years. That has been too much for a decade, meaning that if we compare those figures to the long-term average risk premium of equity markets in a long history, 200 years, that has been about double compared to the long-term average, meaning that we have to adjust the expectations until we have some correction in valuations. And of course, it highly depends on what kind of scenarios you have in the future. If the rates stay higher, if the inflation stays higher than what we have seen in last decade, that might mean that the expected returns for risky assets will stay lower. And illiquidity premium, we haven't seen any correction in valuation there, which means that we need to have a correction until we can expect that to be positive in future.
That's a prescient point, and between I think what Brendan said and Carrie said is where the market is, because you have the, if I may call an insurance investor, the skeptic in the room, and the single family office person, the next level of capital that could be available to the sector, plus 6% expectation and a negative illiquidity risk premium, which could be today. And looking back, I think that's kind of where the bid ask is. I think it's kind of a very interesting time in life of private assets. And if I may add my 2 cents, one of the things that a lot of committees are beginning to do, and especially as some of these companies will have down rounds and some of the managers will have to write down exposure and things of that nature, so those numbers would look less glorifying looking back 10 years. I think some of the committees are going to go and say, okay, are we over allocated? And that could create its own set of challenges, and those expectations could kind of ultimately come in equilibrium over a period of time, but which could mean that there could be 3-4 years or less or more of potential, kind of sideways movement in that type of an asset class. So clearly a significant, come down for this asset class, but potentially some opportunity as well. So coming to a totally different question, we're talking about reducing duration. We had an interesting conversation about hedge funds. So firstly, I would love to understand hedge funds doesn't mean one monolithic term. There could be a million different interpretations of what a hedge fund is. But broadly, in the more liquid, low duration alternative investments, let's just call it that way, i.e. hedge funds with kind of moderate or lower equity risk. How do they even feel about that asset class and its fit in an institutional portfolio from here going forward? And then I have a follow-up question on that, which I'll ask later. But let's first talk about how everybody thinks about hedge funds.
Okay, I can start. As you mentioned, there are the risk and correlation profiles of hedge funds are totally different depending on the styles. And I would say that directional hedge fund, directional styles like a long-short equity funds or event-driven funds, they tend to follow what the risk market is doing, meaning that they typically have some kind of positive correlation to the markets. If we go totally to the market neutral hedge funds like a macro funds or CTAs or market neutral equity, also there, I think that there might be better opportunities in a coming decade compared to the decade after the global financial crisis. In fact, macro hedge funds have had really poor performance during last decade, and that has been the era where the diversification hasn't paid off. Meaning that any way you take risk, either directional equity risk, risk with the private assets, or high credit risk, you have been paid, but any kind of diversifying assets have performed quite poorly. And that also applies to the macro funds like a CTA, so some other funds which are trading with macro variables like commodities, FX, or rates. And now what has happened, what has changed in the macroeconomy is that central banks are not dumping macro volatility anymore. We have more volatility in FX rates. We have more volatility in interest rates, also in commodities. The environment has been, or let's say there are more opportunities for macro hedge funds to operate in this kind of environment where there's more volatility. And that's why I'm a little bit optimistic on those macro type of hedge funds in this kind of environments.
So we have suffered several years very tough for the hedge funds or for the so-called NUSITs strategies in Europe. I think it has been very complicated for them in order to offer diversification, to offer the correlated returns. It has been very, very complicated for them. I think that a lot of investors decided to leave this kind of investments due to this lack of diversification, or at least this perceived lack of the correlation. During the last year, for example, in 2018, it was a very, very complicated year for them. If you remember, the last quarter was terrible, but I don't know, most of them, or at least most of the categories, were not able to offer a good diversification. On the other hand, last year, there were, as Kari mentioned, several categories. For example, CTAs performed very, very well. Global macro, a lot of global macro managers were able to deliver good return. So it was kind of a resurrection of the alternatives in this sense. This is something that maybe with this new interest rates paradigm, with this, it seems that the free money era is not anymore here. So I think that there can be more opportunities for these managers. So they suffered during the last decade, I would say, and right now it seems that they can have more opportunities. obviously, maybe this year is a bit different again because with all this, the hit of the alternative intelligence, well, there have been several technology companies that has been leading the market. So maybe it can harm as well to some of these managers. But in general terms, they could have a new opportunity in portfolios.
Yep. Yeah, I would agree with that. Many hedge funds will do better in volatile environments. They're like a long volatility solution. And given many use leverage, they hold a lot of cash and will benefit from high risk-free rates anyway. So they'll, even if they do nothing, they'll benefit from that. You know, whereas in the past, their high fees just ate away any alpha. So there's a case that, you know, as markets become more volatile and dispersion increases, they could do well. Although with macro hedge funds, given the rapid change in the environment, many get caught out unless there's a long-term trend. Similar to CTAs, they need things to change for the long term and not be choppy, which makes them a little bit more tricky. Whereas I tend to prefer the more arbitrage type of strategies that are more, you know, less dependent on managers getting those type of big calls right.
That is very interesting. I think the perspective on hedge funds couldn't be clearer. I think the dispersion, the opportunity set for, you know, more liquid, more opportunistic, more nimble strategies, well understood alongside. So the challenges that macro could face, where there is turbulence in just there's no one set long-term trend that you know, X is happening, Y is happening. So I think it's very, very interesting from that standpoint. That gets me to kind of a 1B of this question, if I may, which is along the lines of the power dynamics between LPs and certain set of managers, right? I mean, at the peak of the whole venture and private markets boom, we saw that it is extremely difficult. I mean, it's all about getting in with the right kind of managers, some of whom have proven that they've had many challenges in the portfolios and things of that nature, but from a smaller LP clients, it was always very difficult to get even a call back from some of these managers, let alone get onto their cap table. And then there was no negotiation in terms or anything along those lines. You know, again, market dynamics, but that's kind of how it worked. There seems to be something similar happening when it comes to the multi-strategy hedge fund space, right? Where there are only 5, I'm not going to name any platforms, we don't name anybody, but 5, 6, 8, 10, 12 different platforms that have built a tremendous moat. I mean, I had the privilege of working with one such previously in my career. It was fantastic. They're great analytics, great teams. I mean, I totally understand the value of those platforms. And they have a waiting list of people wanting to come in, and they have a great track record of the last 10, 12, 14 years of risk-adjusted returns. Having said that, some of the smaller LPs, or even some of the larger LPs actually have challenges getting in. And part of the challenge is driven by, I mean, it's twofold. One is, again, the backward-looking performance and the moat they have built is solid. Talent, they have the ability to really get in the best-in-class talent and lock them in. And the third thing is they have this huge flow from the retail side, right? When retail wealth managers and others are really aggregated. And again, maybe Juan, you might have something to say here. And some of these platforms have been able to get into these funds and offer a support of capital that was previously not there 10, 12, 15 years ago. All of this means it's tougher for smaller LPs to get into these funds. So curious to know how you guys think about that and what are some of the dynamics playing out there in that landscape.
In my opinion, it's a very, very interesting movement, I would say. There are a new kind of investors. Traditionally, it was only focused on big institutional investors that understood perfectly where they were investing, that they had the patience or the capacity to wait for example, the 10 years plus extensions. So everyone understood the market, and everyone understood the constraints of these investments. During the last years, there are some initiatives, for example, in Europe, but as well in our markets, in order to allow to private banking investors to reduce the minimum investments for the clients. And it could change a little bit. I mean, this so-called democratization could have some implications. For example, first of all, in my opinion, it's very important that everyone explains perfectly to these new investors what are the potential constraints that we have. I mean, I don't know if everyone that is investing in this kind of products is ready to have this 10 years permanence. Obviously, there's like a secondary market. There's some way to sell, but it's not always easy. It's not the same than selling a fund, or it's not the same than going to public markets. So it's very important to know that we will see in the following years, in the next years, if the market stresses, if these kind of investors were really ready for this for these investments, because it could affect in order to I don't know, in case of forced sellers, we'll have to be very conscious of the type of investors that there are in the different vehicles. I mean, I don't know if a huge percentage of retail, well, I would say private banking clients is very interesting for some of these vehicles. I mean, in terms of the permanence, but it's a very interesting movement as well. This is a lot of companies, new companies coming into the market. For example, a lot of traditional investors, traditional public companies, or companies focused on public markets that have been coming into the liquid side, or they have been creating like the illiquid vehicles or the liquid arm of investments. I don't know, by bringing new teams. I know it could be interesting in order of to know, for example, the valuations, because there are more participants in the market, and this illiquid premium could be harmed, or these valuations they can be fighting for or competing for the same deals, and it can affect to the valuations and to the potential returns, and not only in terms of the redemptions, as I mentioned previously with the private banking investors, but as well in terms of the consequences that can have to the performance.
That is fantastic to hear. Brendan, Cara, you have anything to add here in terms of how this dynamics
yeah. Maybe some thoughts when we're talking about illiquid retail vehicles, or vehicles where smaller investors can go in. And I have some concerns that maybe there might be investors in the field that don't really understand what illiquidity means. Meaning that it might mean 10 or 15 years of period that you can redeem your money out, and are they really prepared to keep their money out? And also some other concern is that there are vehicles in the markets that provide some kind of gates to go out, but it's clear that if there's a fire sale selling going on, those gates will be closed, meaning that we are living in an environment where cash flow is more important, and then there are illiquid vehicles that are making capital calls in future that might be difficult for some investors that haven't taken into account all the cash flow needs which are coming.
It's great. Unless Brendan, you have something to say, maybe we'll go to a couple of questions coming through.
Yep, I guess, yeah, in the big multi-strat pod shop hedge funds, I mean, I'm less of a fan. I mean, many of them are increasing their liquidity terms. They're becoming more like closed-ended vehicles, like a private equity, private credit type of solution. So you end up having a very liquid asset in an illiquid format, but still don't get any illiquidity premium. You know, they're basically taking advantage of investor interest, and the fees are like ginormous. And given where risk-free is, a lot of them do struggle to beat that. You know, I find a lot of them, either the risk management is too tight and they don't take enough risk, or, you know, they're just not leveraged enough to generate any sufficient return. So the people that really benefit are the managers themselves, and investors, I think, will get left out paying the high fees and getting the, you know, weak return. I appreciate the risk-adjusted returns are fantastic, but, you know, the absolute level you get back is quite low.
At the back of those poignant reminders, yeah, I really like the phrase of no illiquidity premium, and you know, despite being in kind of liquid strategies or the liquid underlying, there's embedded in liquidity for which you need to get paid. But very interesting. There are a few questions. Before we jump into the questions, one real kind of a rapid fire. There seems like, or it's just one question, rapid fire. Huge level of LP interest, at least across the pond here in a country, India. It somehow is kind of making way into people's portfolios. There's just more institutional investors that I never thought would try and underwrite single country or spend the amount of time and resources and to kind of understand it. How do you guys see India? How are things across the pond? So we'd love to understand from different investors, and then we have a few very interesting questions here which we could tackle.
Well, as a country and as an economy, it has a great potential. I think that there's no doubt about that. Well, obviously, we have been years and years talking about the Modi reforms, and it seems that we can see that the country has been growing. And I know there has, in terms of stock change, it's always complicated to make this sometimes short-term predictions or forecasts. But obviously, I would say that as an economy, as a market, as a country, obviously, it's a great potential over there. In terms of investing in illiquid assets, illiquid markets, obviously the knowledge here is very complicated to know. So I suppose that is more and more important to have these local teams. But as a country, obviously, it's the potential is incredible.
I guess I would add, often I would look at hedge funds, but they struggle to short in India, which reduces their interest in it. So it's harder for me to get excited from that perspective.
I would say that we have already invested in India, and we have private infra in India, and we are quite constructive in that side. I think that there are a lot of opportunities in infrastructure projects. But of course, like in any investment, you have to select carefully your counterparties and your projects.
Great. That's a good and interesting insight. Very consistent with what I'm hearing here. But I guess you guys are a little bit ahead of the curve on the other side of the pond, if I may say, just on average, very generic statement. Now, let's tackle a few of these questions. Tremendous questions. Again, I want to really thank the audience for the number of questions that have come through. But let's thematically understand. I mean, there's one big theme on this whole inflation, and what does inflation mean for our expectations? And we talked about that a little bit around alternatives broadly. What is the impact of inflation and sustained inflation on our allocation to alternatives? So maybe some observations on that would be helpful.
I guess you try and find anything that's inflation linked. So core infrastructure that is directly linked to inflation would help, but those assets are expensive and the returns are generally quite low, and often they would have inflation caps in them. So it's not completely foolproof, but often they're like the most direct way you could, manage the inflation risk, whereas most assets really struggle to, generate sufficient return from it.
Yes, and I think that goes for all the real assets, that if the prices are right and you can basically put inflation into your cash flows, like in infra or in some real estate sectors, if you're not afraid of vacancy rates, then you can get inflation hedge, which might be good in a high inflation environment. But also when looking liquid alternative side, it might be good for some kind of carry strategies in alternative risk premium side, like an FX carry might work in an environment where there are differences in inflation and differences in interest rates. And some other commodity carry strategies might work as well in that kind of environment.
It's great. Maybe we'll tackle one more here, kind of somewhat linked, but the question around, I think, and this question is talking about the diversification benefit of private assets, which is completely acknowledged. There is a diversification benefit in the portfolio, but I think they're trying to go in the direction of asking, what is that little nook or corner or opportunity set within the, call it illiquid or private market spectrum, that's attractive today? Is there anything that's particularly attractive to anyone?
I can start up. There are some benefits on illiquidity when you want to achieve diversification, especially if you are regulated institutional investor who has to be solvent in every day. And when you listed assets, your market values are changing every day. And then you have illiquid assets, and you know that their pricing is delayed and comes typically with 3 to 6 months delay. You can benefit of that illiquidity in your solvency calculation. And a good example happened during the COVID crisis. When COVID crisis happened only during 1 month, equity markets came down during March 2020. And when we reported our first quarter returns, we got negative returns from listed equities. But at the same time, we were reporting fourth quarter returns from private equity with 3 months delay. That was still positive, meaning that we had a negative artificial correlation with the listed and private equity. And 3 months after that, in second quarter, that was totally opposite. Positive returns for listed equities, negative for private equities. Once again, negative correlation due to the artificial delayed valuation of those vehicles. That means that in some kind of insolvency framework, you can get benefits of just a delayed pricing effect.
That's very, very interesting. Does anyone have any perspective? There's a very interesting question on dry powder in private equity, and it sits around 3.7 trillion according to this questionnaire at the end of 22. And is that going to be a problem? And how do we think private equity managers balance out the dry powder? Very interesting question.
Absolutely, very, very interesting, and it's something that we have been talking with some managers during the last months or during the last years. I think that it's interesting in terms of a lot of money coming into this market. I think that there has been great inflows during these years. We have to admit as well that there are I don't know, the percentage of companies that become public is smaller than 10 years ago. So there's still opportunities over there, but it's very interesting this question, because there will be some, or there is a competition in order to get the deals. So I think that these prices can be higher. Anyway, for example, the behavior, the performance of last year, both in public and private markets, gave some opportunities in order to allocate this dry powder. But I repeat, it's very, very interesting. There's an important debate around that, and it means that in order to allocate dry powder, some of them are getting are reaching higher price than they would like to reach.
Yeah.
Sorry,
Kari, go ahead.
Yeah, thanks. I see that also quite problematic, and I think the problem there is that we are totally in a new kind of situation. What we haven't seen in the markets so far is that a lot of dry powder to the private assets, and we don't know exactly what that means. Does it mean, as one mentioned, that the deals are done with a too high valuation? Or is it possible that there will be a longer period with no capital calls or less capital calls? And then at some point of time when listed market liquidity dries down, then there will be capital calls when there are a lot of opportunities in private markets. And in that kind of situation, investors might need the liquidity themselves, meaning that a lot of uncertainties how that will play out.
Anyway, regarding this, it's very interesting regarding the capital calls, that there are some new vehicles in Europe that are using the only one capital call in order to get easier access to the private banking investors, and it's part of the potential problem that you see here.
Yeah.
That's a good point, because often investors over allocate to private equity because they'll never get called at the same time. But if a lot of good deals come online, there could be many capital calls from investors, and they'll have to sell a lot of their liquid assets, which means they'll keep more in cash or liquid assets than they would normally do. In the anticipation, these private equity managers will find good deals and then call the capital at the same time.
Yeah, it's the balancing, the pacing problem is just legendary. And again, perhaps now also would add into what the expectations from the asset class would be. And there are a cluster of questions, couple that I don't understand, but I'm happy to throw it to the panel. One is along the lines of the impact of the investment banks in the US into the alternative market. I don't have any comments on this, but if anyone has any comment on that, I'm happy to do that. Otherwise, there is another question on how do you guys do your diligence on external managers and just your process. And then there is a question on, and maybe you can bundle all these three questions up if someone else has something either, is along the lines of smaller funds. Could smaller funds ever see the light of the day? I think it's very interesting questions. Would large allocators allocate only to large funds? Is there an opportunity for mid-market funds? So I know we are crunched on time, but I think if any one of you want to answer any or all of these threads, that'll be great.
Maybe one point of I don't exactly understand the question of investment banks in US in the alternative markets, but what I see when discussing with the quant teams of major investment banks is that, of course, there are a lot of systematic strategies, quantitative investment strategies that you can use instead of hedge funds to create vehicles, alternative vehicles yourself, if you are able to do that. And there I see the investment bank role is quite big nowadays.
Well, another question regarding the due diligence and the manager search. Well, I would say that it's a little bit more complicated than to create expertise in this area than maybe in the traditional long-only funds. I would say that in terms of obviously the databases are not so powerful as they are in the long-only. For example, in terms of valuation, in terms of all the information that you can get, it's not that easy to have the access. I would say that sometimes it's a little bit more one-by-one process, trying to get to know the managers, trying to get to know the companies. Is not always easy because some of them are extremely or require higher tickets, so they don't want to accept new investors. So it's a little bit different. The due diligence can be a little bit more complicated because sometimes you have to look into the past performance, into the past activity of the teams, and sometimes you are investing in products where you don't have a great visibility of the potential activity of the fund. But anyway, I would say that maybe it could be a little bit more one by one, more complicated to do the research. At least in my opinion.
Yeah, no, I think great insights, Brandon.
Oh, and I guess with regard to the question of smaller funds, I like smaller funds, particularly if they're in a capacity constrained area. And being a single family office, there's no restrictions or rules, so we can allocate to them. And we can also take advantage of the fact that bigger players have other restraints such as ESG and those type of restrictions. But it helps diversify your portfolio because you can have these smaller funds invest in smaller areas and then blend it with larger managers. Whereas if you're a big sovereign wealth fund, it's pointless looking at smaller funds and they can't tap that part of the market. So the answer is, yeah, I see more opportunity in smaller funds.
On that very hopeful and opportunistic note, not just for smaller managers, but I think some of the opportunity sets that we see within alternatives, while acknowledging some of the challenges that are right in front of us, the expectations that are going to be a little different over the next 3 to 4 years. I mean, gentlemen, Kari, Juan, Brandon, you guys were tremendous, great insights. Hopefully everyone that attended, mainly that do what we do, would have really benefited from these exchanges. And I think the list could be endless. There are many questions that are left unanswered, but unfortunately we only had an hour. So I really want to thank you for bringing all your expertise, intent, and insights on this call. And I'll hand it back, Kimberly, to you and the Evenco team to close it from here. And I want to thank everybody that attended this call this afternoon. And feel free to reach out to me or any one of the panelists I'm available on Bloomberg at gpattoncard13 at bloomberg.net. Thank you. Have a good evening, everyone.